So, Craig, right now we were just talking about this S&P very close to a new all-time high, the NASDAQ 100 hitting a new closing high. And in this environment, you're actually raising your recommendation for equity exposure, just a very slight amount from 97% to 98%. But generally, when stocks are at record highs, valuations are elevated, people are looking to possibly move away from stocks. Why are you getting more bullish?
You know, Frank, when we think about all the negativity that we've seen so far in the first half of this year, it's been incredible. Between tariffs, between geopolitical, between budget issues, all these things, the market has shrugged it all off. The market is telling us a pretty solid message that it wants to continue to keep going higher in here. And the only way to sort of reverse that negative sentiment is going to be through new highs. And that's exactly what we think is going to play out. And that's why we've continued to increase our recommended equity exposure. And that's why we continue to reiterate our year-end objective of 6,600 on the S&P 500.
All right, Craig, I'm not going to make it easy for you. The tech sector hit a new all-time high yesterday. So outside of tech, what other sector do you see moving us to these new all-time highs?
Well, we have to have financials working. That's going to be a key part of this. Financials continue to keep working. You look at stocks like Charles Schwab. You look at stocks like Robinhood on the brokerage side of the world. You look at Goldman. You look at the big major money center banks. They continue to keep working. Beyond that, also take a look at the industrial companies. Even some of the pre-market movers, Frank, you were talking about here this morning, fit into that industrial sector with Lennox and some of those others. And then also the service companies. Lots of names on the payroll processing side of things. You got PayPal, that's been a constructive looking chart. Frank, there is no shortage of constructive looking charts. And I think that's an important message we need to pay attention to.
All right. You also seem to like small caps right now. You say there's a technical reason. We're going to show the chart, the 100-day moving average and the 200-day. I'm looking at it. The stock is above its 100-day moving average, but it seems to kind of hit resistance right at that 200-day moving average. At least it did a few weeks ago. What's the technicals that you're seeing here that's making you bullish on the small caps?
Right. When we go look at the chart of the Russell 2000 and you look at it on a weekly basis and go back over the past, say, 24 to 36 months, it has made what I would define as a pretty impressive inverted head and shoulders bottom. And the time frame, when you look at how long it took to set that up to the time frame of where it will ultimately play out, we see about 16% upside. And Frank, I'm not mincing words here, but the Russell 2000 is very likely to make a new high and probably will do so before mid-October.
All right, I want to put that in context. You see it hitting, moving 16% higher, but the S&P you only see moving 8% higher. So you see
Correct.
Small caps significantly outperforming. In this environment, we have tariffs. We're not really clear on Fed rate cuts. There's some talk about July cuts. What's the catalyst? What moves these small caps higher?
Well, the fact is that a lot of these small caps really got beat up in the downturn in April. We saw the Russell off over 30% from the highs, and now we're starting to see the Fed signaling, but perhaps that they are going to lower rates. The inflationary pressures are coming down. The economy has been a lot more resilient than people have been thinking about, and we're seeing from a chart perspective a broadening of the participation of this market. So if you're looking for opportunities that haven't already been exploited, you're probably not going to find that in the Mag 7. You're going to find that down cap. And then also, Frank, fear of missing out, FOMO. The FOMO trade is full on at this point in time. There's a lot of managers that did not get out of the way in the downturn in April, did not re-engage in this market as you got into the May and June timeframe. And with the market making new highs, the pain trade is squarely up. They need to play catch up. And your better opportunities are down cap versus trying to go and play, say, Apple or Microsoft at this point in time.
You're also underweight transportation. We're just coming off FedEx earnings, looking at FedEx, and the pre-market is down, and that's based on current quarter guidance. You look year to date, FedEx shares down more than 20%. But if you look at transportation more broadly, I like to look at the IYT transportation ETF. It's up about 0.5%, underperforming, but still up 0.5%. Why underweight transportation when you're bullish on small caps? Aren't they very closely tied?
Well, they're a small part of the overall index. The bigger part of the index is going to be industrials. It's going to be technology. It's also going to be healthcare and also financials. And the parts that are the larger components inside of the Russell are likely to be a bigger driver of this. If I look at the IYT as an example, it's been showing sort of poor trend, poor relative strength. So lots of competition in the transportation sector, whether it's airlines, rails, or even some of these delivery areas. There's just better opportunities elsewhere, and it's not in transportation.
But, Craig, in all fairness, aren't both very closely tied to U.S. growth, U.S. economic growth? They're both really domestic plays, especially when we're talking about transports. Yes, they have exposure to overseas shipping, but the majority of their revenues really come from moving freight here in the U.S. So If you don't think those companies are having higher revenues, why do you think the other domestically focused small caps are having higher revenues and higher earnings?
So when I've gone back and sort of dug into that exact rationale, there's a lot of competition on the trucking side of the world that needs to be addressed. They've been very competitive on their pricing side of it, and that's been creating the challenges on the transportation index itself. And then also, we do need to see fuel prices come down for the airlines, and that would be helpful for them. The recent surge that you were talking about just before this segment, Frank, about oil prices going higher, has certainly led to higher prices and higher ticket prices. So that
Okay.
has also been a little bit of a margin squeeze for some of them.